a catastrophic decline in oil prices. Africa's largest two oil producers are now cutting budget projections, and the economies are under quite a bit of pressure. We'll be looking at the details on exactly how they're going to cope and what the options are for both Angola and Nigeria moving forward in the next half hour. This is Global Business Africa. I'm Ramanyang in the Kenyan capital, Nairobi. Here's what's coming up. The mixed reactions in South Africa as residents digest the outlined budget proposals. And in the second part of our focus on digital migration in Africa, we'll be interrogating the process in Uganda. Private players are pretty aggrieved. Right, we'll not be starting in the business of media, we'll be starting in the oil sector. Nigeria's Senate has further cut down the oil price benchmark in the country's national budget for 2015 to $52 a barrel, down from the $65 a barrel proposed by the government. Now, this is the third time in a couple of months that the benchmark has been revised downward, following the fall in global oil prices which started in June last year. The Senate has also carried out other cuts to the budget proposal. Here's Deji Badmus with more.
The cuts by the Senate did not come as a surprise at all. With oil still trading around $61 a barrel, the benchmark of $65 proposed by the executive arm of government was simply not tenable. And so the lawmakers have now cut it down to $52, which some analysts say is the right way to go.
Now things are tight. I think 52 sounds about right. They've also benchmarked the exchange rate at 190 naira to a dollar, which kind of makes sense because, yeah, if you say it's 200 and you pick at 200 and you expect more money than you actually get, and you don't get that, it might cause some problems and cause wrinkles in the way you deploy and manage your finances. So I think it's a prudent figure, and hope that level of prudence would continue to prevent the thinking in Parliament going forward.
The Senate also cut down on the recurrent expenditure of the budget and raised the capital vote from 633 billion to 700 billion naira. But one surprising thing the Senate did was to cut down its own budget by 25%. Now, Parliament's budget has always been an issue of controversy. People had always complained lawmakers were earning more than they should. Well, the economic situation in the country has now forced the lawmakers to finally accept a pay cut. Deji Badmus, CCTV, Lagos, Nigeria.
Elsewhere, Angola's parliament has passed a revised $51 billion budget for 2015, potentially cutting spending from its original plans due to volatile global oil prices. Now, oil accounts for roughly half of Angola's GDP, 80% of government tax revenues, and about 90% of export earnings. The revised budget figures are based on an oil price assumption of $40 a barrel, much lower than what Brent crude futures are trading at right now, and also more than half of what the previous forecast was, of over $80 a barrel. Also, another key assumption, it predicts a budget deficit of 7% of GDP. Capital expenditure will be halved. Spending on recurrent costs will also be slashed by 30%. Now, the more than 60% plunge in global crude since June last year will result in a current account deficit of about 19% of GDP. This will be the first time Angola has posted a deficit since 2009. Now, let's explore this subject further with Miriam Bemard. She joins us live from London. Miriam, the decline in Brent crude, that seems to have hit a bottom of sorts in late January. What's supporting the recovery since then?
Well, Rama, Brent crude a bit lower today, though, hovering around $61.74 a barrel, just off of that rally we saw on Wednesday when oil prices recorded their largest percentage gains in 2 weeks. The main factors at play here, Rama, is optimism that demand is picking up. Some analysts I spoke with are hoping OPEC will call an emergency meeting. We saw signals of that earlier in the week. That could potentially create some foresight in prices. There's ongoing debate between those who think we'll see prices go back up as much as $100 a barrel, although it seems a bit too optimistic, and those that think between $50 and $60 is now the new norm. Investors are more confident that OPEC members may consider reducing oil supplies this year, despite Saudi Arabia being vehemently opposed. Of course, we saw that in the last meeting as well. Experts say that OPEC, which dropped its traditional approach of lowering production to keep prices high, will instead focus on defending market share against oil producers like the U.S. that could help sustain prices.
Indeed. Let's focus on one of those OPEC members, Nigeria. Doesn't this fall in oil prices essentially reduce the impetus, the incentive, if you will, for Nigerian legislators to finally get this long-delayed oil bill done, dusted, passed and out of the way?
Well, it's difficult to say. You know, it would be surprising if we see any announcements just yet. The common expectation is that Nigerian policymakers will remain cautious and monitor the volatile prices. Despite being lower, we are seeing that fluctuation in the market, especially because the petroleum industry bill has gained notoriety among international investors. You know, analysts say that policymakers are reluctant to address all of Nigeria's oil and gas sector problems before actually having more clarity on the direction of prices. Legislators are still grappling over whether or not the new norm price will be around that $52 that you were just saying per barrel for 2015 to be approved against that $65 per barrel projected by experts and analysts. It's a big difference there. And investors will also be looking to see if the oil bill will force the government to consolidate its fiscal strategy to narrow that gap between projected and actual revenue for the next 2 years, reducing things like oil theft and looking at ways to diversify Nigeria's economy and perhaps increase things like the tax bases.
One last question for you, Miriam. Many in Nigeria do complain that the kerosene subsidy that the government there implements simply does not get down to the end consumers on the retail end. Do Nigeria Focus analysts on your end expect further cuts to that subsidy to be made by the House of Representatives, similar to what the Senate has done already?
Well, the common thought is that we won't see any further cuts for now, but analysts say that the government has to find a balance really between reducing the price pressures on Nigerian consumers and continuing to reform policy and raise capital for a very fluttering economy. You know, we have to remember the government is also trying to diversify its economy while it moves away from dependence on traditional sectors like oil. So it needs to strengthen its domestic demand, and that coupled with the naira falling to record lows means that Nigeria cannot count on its usual revenue streams and foreign exchange earnings. So the weak export calls for belt-tightening measures while they find new ways to actually cope with the slide in revenues that we're seeing.
Indeed. Pressure all coming through from black gold. Thank you for that. That's Miriam Bemad live in London. Let's turn our attention now to fiscal policy, specifically in South Africa. Mixed reactions are coming in over that country's new budget, which was presented earlier this week on Wednesday. The finance minister laid out a fairly interesting financial plan to cut debt and raise revenues at the same time. Africa's second largest economy, of course, is facing a variety of structural challenges. Power is the biggest one of that lot. It's remaining the biggest challenge to growth in the future. The economy is also forecast to grow by just 2% this year, a fairly dismal number. As Sumitra Naidu reports, many say that in this current climate of low commodity prices and slow growth, this budget is fairly ambitious.
South Africa's power crisis was top of mind as Finance Minister Nhlanhla Nene delivered its $140 billion budget in Parliament. The utility is running out of cash and new power plants have been delayed. Eskom has been receiving loans from government since 2008 and it's still not enough.
The 60 billion was a loan. It was a subordinated loan. So when we convert it to equity, it means Eskom doesn't have to pay it. Because when it is still a loan, it is on the liability side of their balance sheet. But when you convert it to equity, it now becomes an asset.
A further $2.3 billion will be made available this year for Eskom.
Need a new business plan, need thinking outside the box. So it goes further than simply allocating more funds to certain parastatals, but to inspire confidence in their restructuring that they can indeed serve the economy and not act as a constraint on our growth and employment.
South Africans will also pay 1% more tax on their personal income. Nene also hiked taxes on fuel, roads, alcohol and tobacco.
The increase in the fuel levy as well as the increase in the road accident fund levy, if you add them up, it's quite a big amount, and that has a knock-on effect. It obviously increases your transport costs, which then increase your cost for your goods and services. So ultimately, the consumer, the man in the street, would ultimately pay for that.
But the minister outlined plans to create jobs and improve income. The Small Business Ministry, which is less than a year old, was allocated $350 million.
The biggest challenge really for small and medium enterprises is infrastructure, because if you go to the township, for instance, most of them are operating in very dingy environment. The buildings are there, but the equipment is very poor. The equipment is very old. We need to go in there and see what is it that we can do to make sure that they improve on the technology that they're even using.
With growth projected at just 2% this year, government's goals to reduce unemployment and raise revenues may be hard to achieve.
The major risk is, will Eskom and will the energy enable that? And that's the biggest risk, and nobody knows, quite frankly. If we go to a stage 3, 2% is way too optimistic. Even 1.5% is optimistic. So it all depends on the energy availability. Public sector wages and salaries. That's a big number. He mentioned it's 40% of government expenditure. But how on earth is going to keep it below 5% or at around 5%?
Labour is already pushing for 15% wage hikes. That's more than triple the current inflation rate.
The workers must go and fight for their wages, because you increase everything and refuse to increase the salaries of the workers. It's not a friendly budget to the working class, and that's why we are rejecting it.
It's going to be a tough year for South Africa. Wage negotiations in most sectors will get underway in the next month. In the meantime, Eskom is working around the clock to get its new power plants operational, with the new deadline set for June. Sumitra Nadu, CCTV, Cape Town.
Let's make a quick run through equity markets here for you. The Kenyan bourse, of course, turning around from the losses that we've seen in the last 4 or 5 trading sessions, up by about 1/10 or so earlier today. A fairly interesting set of stocks being focused on in the next couple of weeks. Banks, because results season is now kicking in. KCB's released their numbers, CFC Stanbic as well. But energy stocks, KPLC, Kengen, and of course the oil firms, Kenol Kobil and Company, they're getting quite a bit of attention as well. Angry Somalis continue to protest over the continued closure of cash transfer services abroad. And in the second part of our special focus on digital migration in Africa, we'll interrogate the process in Uganda, where private players are pretty pissed off. We'll tell you why. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening.
Global Business, weekdays at this time on CCTV Africa.
This is the first year that Africa will have more foreign direct investment than aid. And it's like the tipping point in terms of changing the way the continent is perceived. And I think this summit very much responds to that call. Now, whether it can materialize what is being announced is something that we'll have to check and see whether it happens.
Welcome back to the program. Let's talk about 8 Miles, a private equity firm backed by rock star and activist Bob Geldof. It's acquired a 42% stake in Orient Bank, a medium-sized outfit of Ugandan Commercial Bank. The UK-based firm says it has been raising funds for the last 3 years to invest in African companies. Here's Hilary Esiga with more.
Orient, like many other Ugandan banks, has been struggling to make profits. The country's banking institutions do business in a country where only 21% of the population has bank accounts. Nonetheless, 8 Miles is optimistic about the future.
I think our results for this year will also not be very good, but 2015, 2016, we want to make sure that the bank is profitable once again.
In 2013, Orient Bank reported a loss amounting to $5.4 million. The shortfall was attributed to non-performing loans.
So our first priority in the bank is to restore the controls and the discipline and the risk management in the bank. Once we have a strong foundation, we will then grow the loan book, but we will do it in a very disciplined and careful manner.
Ketan Mojaria is one of the bank founders and says the new partnership with 8 Miles will now push the bank to be a market leader.
This acquisition means that, the old guards are back in the institution, and we want to really revamp the institution, take it back to its former glory, and try to bring the best financial services to the public of Uganda.
Orient Bank has 23 branches in Uganda with assets worth $173 million and customer deposits of $139 million. 8 Miles LLP's move comes at a time when investors are rushing to target Uganda's nascent oil and gas sector. Access to finance will be important as part of that process and may play a part in restoring Orient to profitability. Hilary Yesiga, CCTV, Kampala.
Elsewhere, businessmen and residents of Mogadishu continue to take to the streets to peacefully demonstrate against US Bank's closure of remittance accounts. Now, they're concerned that families will not be able to put food on the table if remittance flows are cut off. American banks shut down the remaining accounts of companies that are operating money transfer services from Somalis in the diaspora. Somali's government has been pushing for review, but many have already been affected by this closure as efforts are being made to restore the services. American banks have been keen on tightening the noose on money laundering and the financing of terror altogether.
We request the American government to intervene and try to figure out how these services can be restored even on a short term. Until that time, the business people can fulfill these conditions.
Without remittances, Somalia will not have reached this far. Families survive on the $50 and the $100 they receive from their kin abroad. This country has been through a lot, and cutting off the remittances will deal a big blow on us.
The Mayor of London, Boris Johnson, is accusing the former UK Prime Minister Tony Blair of playing an alleged shameful, quote-unquote, role in Zimbabwe's current economic state. He says the abandonment by Britain of compensation for white farmers who lost their land under President Robert Mugabe's land appropriation policies set in train the path to Zimbabwe's current economic woes. Here's Richard Bestick from London.
This outburst from Boris Johnson, a rising star in the British political firmament, is triggered by the $1 million celebrations being prepared for the Zimbabwe president's birthday. Writing in the London Daily Telegraph, Johnson says the birthday bash will be staged at a time when Zimbabweans are struggling to live on just 35 cents a day. Zimbabwe, according to Johnson, now the second poorest nation on earth. In his article, Johnson writes that former UK Prime Minister Tony Blair's government was in part to blame for turning Zimbabwe from agricultural breadbasket into economic basket case. In what Johnson called a fit of avowed anti-colonialist fervour, Blair's 1997 government scrapped critical elements of the Lancaster House Agreement, an independence deal agreed between the UK and Zimbabwe that compensated white farmers who sold their land. It was the abandonment of the compensation agreement, claims the London mayor, which gave rise to President Mugabe's land reform policies, the confiscation of white-owned farms, and ultimately Zimbabwe's economic disaster. Richard Bestick, CCTV, London.
Right, on to the business of media. Broadcasters in Uganda are a worried lot, especially the private ones. They're concerned that the country may not meet the mid-June deadline to migrate to digital terrestrial transmission platforms. Now, media owners say the Ugandan Broadcasting Corporation, which is tasked with transmitting that particular signal, is facing challenges with capacity. And that in turn may delay the full-scale transition from analog to digital broadcasting. In the second part of our special focus on digital migration in Africa, Michael Baleke brings us up to speed with the situation in Uganda.
The digital transition is a global process involving the switch from analog to digital broadcasting signals. Uganda switched to digital broadcasting in August last year. However, at present, this only covers a radius of 65 kilometers around the capital Kampala. So most of the country is yet to experience the changeover, and this trend is worrying broadcasters.
The current law only allows for one signal distributor and that person was given 5 years, at which point that will be reviewed. Now, the 5 years end next year because they were given this license 4 years ago, and they've not put anything in place. So we are questioning that. And again, that alone demonstrates the inability of Signet to be able to distribute this signal.
Uganda's Communication Commission, which regulates the transition process, says the country is rolling out the new broadcasting platform in phases. The regulator says almost 70% of people with television sets in Uganda are already receiving the digital signal.
We, as a commission, believe that the major ingredients of digital migration are in place. All we need to do now is to heighten the awareness campaign so as to drive the country towards this migration.
Digital broadcasting is far more efficient, allows better picture and sound quality. It also has the potential to increase the amount and variety of television content and increase consumer choice. Some broadcasters here in Uganda have long migrated to the digital platform. However, the biggest hurdle for most African governments and regulators remains the cost of transmitting the digital TV signals to consumers. Consumers have to buy set-top boxes usually costing around $50 or a digital television which is in a price range of $300. In Uganda, the regulator has approved 8 private vendors to import and supply the free-to-air set-top boxes in a hope of driving the prices down by increasing competition. But this is still not affordable to most locals.
They do not have the financing to be able to set up the full signal. We are asking as broadcasters to be given the second license to carry the signal. We've got capacity amongst ourselves, we've got infrastructure amongst ourselves, and we've got the capital equity to be able to invest in the infrastructure.
African countries committed to migrating to digital broadcasting by the mid of June 2015. If they have not done so by that date, they will not benefit from the protection offered by the International Telecommunication Union against signal interference. Michael Baleke, CCTV, Kampala.
Right, then let's make a quick run through commodity prices here for you. As you mentioned earlier in the first part of the bulletin in our conversation with Mariam Bemard, crude prices still hovering around the $60 a barrel mark. However, of interest to us is some data coming through from Ghana. The IMF says it's agreed to a 3-year deal with the country worth about $900 or so, $30 million, give or take. If you remember, this is a key gold and oil exporter. So we'll keep tabs on this story, look at the details and terms of the deal in the course of our broadcast later on. Next, we'll take you on a spice tour of the exotic, lovely island of Zanzibar. All that and more is coming up next.
Having lived in 4 different African countries and with a diverse background, I cherish the personal as well as professional experiences I've had across the continent. It's this understanding of the place I call home that drives me to tell stories about its people, its needs, present and future.
There's just so much happening in Africa in terms of the way forward and development. It only brings positivity.
My place at CCTV Africa is about creating awareness around the realities of a continent that is indeed complex, vibrant, and has great potential.
Africa is my home. How it prospers, the challenges it faces, its people all matter to me because this is my future. I'm Famida Miller and I'm a reporter and anchor at CCTV Africa.
Welcome back. Now, when one thinks of Zanzibar, its nickname, the Spice Island, usually does come to mind, and that conjures some fairly interesting images, heady, exotic aromas of rich, exciting flavors, most of which are 100% justified, by the way. You see, for centuries, Zanzibar has been a hub for merchants and explorers, and right now, tourists. One of the key attractions for visitors is what's known as the Spice Tour. Maria Galang visited one of the island's farms. She filed this report for Grassroots tonight.
Jambo, hey jambo bwana, habari gani? Nzuri sana, sisi wageni, mwakaribishwa.
Deep in the forest of Zanzibar's Uganda Island, Abdu begins his day at work. He climbs some of the island's tallest coconut trees to collect young coconuts. His performance is part of the Zanzibar Spice Tour, which attracts thousands of tourists every year. The spices have a long history, but they're not indigenous to the island. They were brought here by the Portuguese and sultans from the Oman Empire.
This sultan were moving from different countries, in Morocco, in Indonesia. Some of them they went to Mauritius, Madagascar. So according the way they pass, they just see what they like to bring to their country to help them to get some income.
I had no idea it grows like this.
Guides take you on a walking tour of the plantations, picking bunches of leaves and fruit from bushes and inviting you to smell or taste them to guess what they are. Vanilla, cardamom, chilies, turmeric, lemongrass and nutmeg can be found on the island's spice farms. There's also a wide variety of exotic fruit and flowers.
Now, one of the world's most popular perfumes is Chanel No. 5, and one of the key scents in the perfume is the lang lang flower, which grows quite commonly here in Zanzibar. The locals have even come up with their own version, which they call Chanel No. 1.
The most important spice, however, is what the locals call Zanzibar gold, cloves.
This was the first spices brought here by Said Sultan from 1818, before he came to rule Zanzibar. At that time he passed here to visit Zanzibar, and he went direct to France and France to Morocco. So he got the seed from France, while the French they got it from Morocco, and come to try to plant if they can survive, and it survives well.
Zanzibar once enjoyed a near monopoly in world markets, and its cloves still reputedly yield the highest quality oil, flavor and aroma. But its production of the spice has slipped to less than 10% of the world market. Under Zanzibar law, farmers may only sell cloves to the Zanzibar State Trading Corporation. Many smuggle their crop to neighboring Kenya in search of higher prices. Farm owners now mostly depend on tourism to make a decent living. Every day, several groups visit the farms. Tours cost around $10 per person, and packed dried spices and perfumes are also on sale. Although the spice trade has declined, the spice store remains one of the key attractions for visitors to Zanzibar. Maria Galang, CCTV, Zanzibar.
And of course, Zanzibar remains as pretty as ever. We can't, however, say the same thing about currencies. Well, not all of them anyway. The Naira is expected to remain between 198 to 202 Naira to the dollar in future. However, keep an eye on the steady, especially on the back of that deal, the staff level agreement to the IMF worth about $940 or so million. How will that affect this currency? We'll find out next week. Now, just before we go, here's what we're working on for tomorrow's program. As I mentioned earlier, Ghana's finally concluded talks for budgetary support to the IMF. We'll bring you details of that deal, what it means for Africa's economy, or rather Ghana's economy as a whole. And we'll also be focusing on Nigeria, the final part of our focus on digital migration in Africa. How is this working out in Nigeria? What does the switchover mean for the media industry across some of the largest media markets in Africa? All that is coming up in the next 24 hours, but that's it for today's edition of Global Business. We'd like your feedback on what we do around here. Global Business Africa @cctv.com is the email to use. Facebook and Twitter, of course, are your ports of call as well. I'm Raman Yang in Nairobi. See you tomorrow.